with this and then let folks in. They're joining up right now. Good morning.
I didn't know Dusty was coming on. Nice.
Right, everybody, welcome and good morning. My name is Harmony. I am with the Fix It Fair, and we are so happy to have Laguan here from Financial Beginnings talking to us about credit and debt. This is run more like an interactive class, so just a couple housekeeping things at the beginning. I am gonna have everybody on mute while the presentation is going, and then if you have a question, feel free to ask that when we're prompted to, or you can drop it in the chat at any point and we'll read those questions out loud so that way we can get those answered for everyone before the end of the session. With that, I'm going to go ahead and pass it off to you and have you take it away.
No problem. No problem. Good morning, everyone. Laguan Mitz, volunteer with Financial Beginnings. Today we're going to be going over credit and debt and just diving into it, having fun. I definitely like to teach more of an interactive style, and so for those that are on the Zoom, if you want to unmute or type into the chat box like Harmony said, great. For those on Facebook Live, I know it'll be a little harder to track that from my angle, but maybe Harmony can chime in and share with us any thoughts that people have on there. So as far as just credit and debt, you know, what is it to some of the folks? Is it a bad thing? Is debt a bad thing to have? Kind of give me your thoughts on that.
For me, when I was younger, it was a bad thing to have because I wasn't informed. I didn't know how to use it. I didn't know how to do it well. I didn't take care of it. Now that I'm older and I'm more informed, I feel like it's a good thing.
Absolutely, absolutely. What was the underlying piece where you felt informed and why it's now a good thing to have?
Well, I think it's easy to manage once you know how to manage it. So taking a class, in fact, I took a Financial Beginnings class before I started working for the company, and it opened my eyes and I thought, oh my gosh, it was a light bulb moment. I figured it out.
Absolutely. No, that's fair. That's fair. Tom, I see your hands raised. You want to chime in?
Yeah, I mean, I would just agree with what Dusty said. I mean, I think there's good aspects of debt, and obviously there's bad aspects of debt. You know, the easiest one to think of is at the point in time where you realize you can't afford to cover all the different payments. So I think the thing about debt is it's the management of, you know, are you able to manage it and handle it, or is it more managing you and taking away your choices?
That is fairly spot on. I'm going to share my screen with you guys here. I forgot to do that.
I was gonna chime in too. I know for me in the last year, I've had to work on building debt, I guess, because I buy a house. So it was like, I didn't have any, I didn't use credit cards. My car's a 2002, but to be able to get a mortgage, I needed to show that I could repay debt. So then it was like this process of, oh, I need to get credit cards and build that track record. So it's not a bad thing. It was just a thing that I had to do before I could get a home.
No, absolutely. I mean, that's fair. That's fair. So as far as like what I'm hearing from the answers is gathering the debt, as long as it's not managing you and you're managing it, and understanding how you can leverage it, it is how most people have come to or have overcome the obstacle of not knowing, you know, it being bad versus good, which is great to hear. Having some issues with sharing the screen, but as far as leveraging debt, I guess segueing into that, how are some ways that the two of you or the three of you have leveraged debt thus far in your lives, if you don't mind sharing?
Well, I'm happy to share that I used student loans to get a degree, and that degree helped launch my career. And so it was debt. And at the time, I didn't understand how that debt worked, but I leveraged it ultimately to earn the income to pay it off and then some.
Nice. And anyone else?
I would say, I think what Dusty just said, that's an excellent example of leveraging debt positively, and using it correctly. Another good example I would say is a home mortgage, right? It would be pretty unique for someone to be able to pull the cash out in order to pay an entire loan, or an entire purchase price of a home. So utilizing debt in order to buy a house is another way that is a good way, from my perspective, to use debt.
Right, and that's probably besides a vehicle, that's probably the biggest one out there. Whether it's residential or commercial, is buying real estate and pulling that credit / debt into your realm. It's going under your tax ID number, right? So putting that immediately under your realm and being able to leverage that for future gain, whether that's for personal or business related things. And so still having some trouble sharing my my screen for whatever reason. The privacy preferences is not loading up, because of course my laptop decided to update last night, even though I didn't tell it to. So we'll move into credit. As far as what credit is, and that's a very vague question, like what is credit, because it's different to a lot of people. And so that's why it is vague, because typically answers from everyone can be different. So how is credit affiliated with you folks?
It's funny, when I looked at the title of this workshop, I have a business degree, and so in accounting classes, credit and debt kind of had different definitions than I think we think of it in life of, like, credit and debt are the opposites, versus us in our everyday world see them tied together and the same a lot of times, like that if you're taking out credit, then you're in debt. And so I was like, oh wait, what are we even talking about today? So that's kind of where my mind went. But there's always a connection, but depending on what you're using as your definition of those two words is how they correlate with each other.
Absolutely. Thank you for sharing that.
I would say credit is really, it's your availability, right? It's like, I have a credit card. The debt is the balance on the credit card. So, I kind of would differentiate maybe that way.
That's fair. The two most common that people think about when leveraging credit would be education, right? Student loans. So even though student loans can affect your credit fairly minimally, as long as you pay them over the 30 plus years that people do respectively, that and then the mortgage, which we had just spoken about, those are the two most common that people think of as far as being able to leverage what credit is and what it can allow you to do for future tenses. But then again, we also have consumer credit, right? And how well we're able to pay our bills on the day-to-day, week-to-week, month-to-month basis allows that credit score to go up or down, which really tells you how much money you're wasting if you're not somebody that pays your credit cards off every single month, which is not normal, but a lot of people have to understand how to do that. Otherwise, they're simply giving their money to Discover, Visa, and other folks. Did you see that, the gal in the waiting room? it to connect over. So as far as where does credit come into playing besides for buying a house, buying a car? What are some other areas that you can apply and use credit, or where they might pull your credit?
For a credit card, if you do any of that, or sometimes for a job.
Correct. Depending on the job, some people do pull your credit. You know, you can't try and go and work into a financial institution, depending on what they do specifically. If you have poor credit, if you're going to be handling the funds of the organization, that's just not going to happen. Great.
I think auto insurance. I've heard that some auto insurance companies actually tie your credit score to the rates that you might get.
Oh, really? That's a new one for me. That's a new one for me, and I like learning new stuff. If auto insurance is pulling your credit, hey, I know it might not be a hard inquiry, but you know, an inquiry is an inquiry, and so having that there could, depending on how many small inquiries you have within a 2-year period. Usually they're only hard inquiries that are judged, but if you have a ton of small and hard inquiries, and the folks that pull them can see that can negatively impact your credit. Renting an apartment or a house, that's a huge one. I think we need a place to lay our head and would like to have a roof over our head, and so that's a huge one that a lot of people forget about. Is when you go to apply for that new place, they may pull that. And I've heard in recent years they've also started doing that with getting phone service. Sounds kind of silly, but it's one of those things that, you know, I think we all do take for granted. You know, have you ever tried traveling from wherever you're at to the nearest international airport, whether it's a 30-minute flight or a 3-hour flight? If you did not have your phone, how difficult would that be? Or could you do it just fine? You can't walk up to the ticket counter and write a check to buy an airplane ticket these days. I don't think you can do that anymore. You might be able to, but who knows? So, yeah, credit plays a big part, plays a big role. I'm looking up because I have multiple screens. I'm not ignoring you guys, I promise. Try and pull this down to this screen and share. Can you guys see that yet?
Not seeing anything.
No, of course not. Harmony, are you able? Did you send? Do you have the PowerPoint in your email?
It's downloading right now.
Okay.
So as soon as I get it downloaded, I can try to share my screen.
All right. Yeah, of course. I've loved Zoom up until right now, while we're live, but it's all good. We'll have that up in a GIF. Okay, moving on. So responsibilities as a borrower with credit. I'll help you guys out. There are 5 big ones, but what are the responsibilities? I'll give you the first one, but I would like us to come together and figure these out. The first one is borrow only what you can repay within the next 30 days. What are some other responsibilities as a borrower of credit? Anyone? Is it Liza or Lisa? Tom?
Well, I think what you just said, I mean, it's about management. of your credit, right? So if you use it, I think maybe first it's making good choices why you're using credit versus saving for something, waiting, saving for it, and then paying in cash.
Right. Any other takers? I'll give you the second one. Reading and understanding your credit contract. A lot of folks, I mean, especially when you sign up for a Macy's credit card at the register, you're not reading the fine print. You're not understanding through and through what exactly your APR or APY is for your credit card. It may be of a floating rate, which means it can go up and down. It's not just locked in at the 15 or the 24%, whatever it is when you open that credit card. And so that's huge. Being able to pay debts promptly. Like I said, if you can't pay that, if you don't have the money, you shouldn't buy it. But if you know, because some people have salary and they get paid systematically rather than on commission, if you can't pay your debts promptly in those next 30 days, you shouldn't be putting that money on a credit card. That applies to myself in the past as well, running it up. You know, when I moved and started my career, I ran up maybe $6,000-7,000 in debt. And then I was like, two out of the 12 months that year, I paid for rent on a credit card. And like, that's, even though I'm in a 100% based commission industry, you know, you can't do that. You can't do that. Otherwise you can get in some big trouble with your funds. Notifying creditors if you cannot meet payments is huge. And yes, you may or may not have to get the right person on the phone, but them putting a note on your file, letting whoever looks at it next know that you called in to handle your affairs and you're not just trying to run from them and be irresponsible, that's big. Because when you call, if you owe somebody, you know, $5,000 and you have $3,500, $3,800 of that, they may be willing to, there we go. Let's go in, I believe we're on slide 4. No, 6, 7. Boom. Go back. Notifying creditors if you cannot meet payments. That's huge, because when you're dealing with a company, if you don't have the full amount but you have a good chunk of money, they may be willing to just take the $3,800 out of the $5,000 that you owe them and call it good. Does that happen in every situation? No. But if you have a good track record with the company and you've been keeping great communication with them, they do have the ability to do that, especially if the $3,800 was the base, not the interest, but the base of what you owed them. Because some of these companies never get that money. Some of them do get their money, or they're just willing to chase for years to get it. And reporting lost or stolen credit cards promptly. I mean, I think we've all read the back of some of those cards, and there's definitely a number that you shouldn't just have on the card because it's lost, but you probably should save that in your phone and have that for the couple credit cards that you have. If you have more than 10 credit cards, I wouldn't advise you to close them out, but I would advise you to put 8 of those, if not 9, into a safe and not use them.
Oh, sorry to interrupt. We do have a question on Facebook. We can do it now or at the end. Just let me know.
Yeah, no, let's address it as we go.
Okay. So the question is, I'm looking to finance a new or new to me car. I do have some amount of existing debt. How do I determine what amount of new debt is acceptable to take on?
Price versus debt to income ratio. It's different for everybody. That all depends on how well you manage your money. But your debt to income ratio, and you can Google it for your specific situation and know, okay, I make this, I have this much debt already. I should or should, I mean, it should tell you whether you should or should not take on X amount more. Most people do not want to have out of their, and I know we're talking about credit / debt here, but most people do not want to have more than 30% of their available credit. So, I mean, if you had a credit card with $1,000 limit, you should not have a standing balance of more than $300 on that credit card at any given time, because that can negatively affect you. And like I said, I know that that doesn't necessarily answer the question directly for how much debt should I take on versus what I have already, but I would have to, I would, as a financial advisor, have to know the specifics to that, which I don't want you to put out publicly to answer that question in a more direct manner. So I apologize for that. Can we go to the next slide? And so if you can't pay, like I was just saying prior, keeping in contact with creditors is huge. Credit counseling, I haven't personally dealt with or seen somebody have, a credit counselor. But then again, a lot of this stuff is simple to a lot of people and difficult for others. So if those difficult people come across somebody that's more simple for, like myself, and just talking through budgeting and how to manage your funds, it can become a simplified process. But do know that if you are not willing to take responsibility for your the management of your funds in general, and it has something to do with credit and debt, that can have a significant impact on your credit. I mean, 7 to 10 years for something to come up, for a negative inquiry to come off, is a long time. I hope you don't plan on, having any more kids or buying a house or refinancing or getting a car, any of that stuff that requires hard inquiries in the next 10 years. Otherwise, it's going to negatively impact you. And bankruptcy is last resort, as it says there. But there are certain cases where folks know that they are never going to be able to get their head above water. And so bankruptcy and losing out on, however far down it takes your credit score is better than, drowning over the next 15 to 20 years and not declaring bankruptcy. And so in certain cases, and you might want to get a second opinion if you hear from one person, but if you hear two people that work in the financial industry and specialize in that tell you, yeah, I mean, bankruptcy is probably your best option, then I would definitely take that to heart, because there's not a lot of people that are in that situation, but long term, it's going to be the better option for you rather than trying to pay back XYZ amount of money. So any questions on those there? I know that was a kind of a lot to throw at you guys. Want to make sure I'm covering the bases and answering any questions that folks have. Okay, great. So moving on, there are some debts, you don't have to go to the next slide yet. There are some debts that do not ever go away. And so I'm curious to see if the audience knows. They might have got a glimpse just a second ago. But I'm curious to see if you guys know, what are some debts that never go away? Anybody want to take a stab at it?
Student loans don't go away, do they?
Student loans, that's a hybrid one. Thanks for throwing that one at me. That's a hybrid one, because there are plenty of industries that do have student loan forgiveness programs. If you work somewhere for 4 years or 8 years, it's probably in the middle of Timbuktu nowhere. But if you have $90,000 of student loan debt, is sacrificing 8 years of your life to live in the middle of South Dakota, respectively, if anybody's from South Dakota, is that worth the $90,000 payoff? Can you move out there, make a decent living? If you have a significant other or family, or if you're just a single person just grinding, is it worth it? And individuals have to take that for granted. But that's the only type of situation, and it's more so related to like health and education industries and professions that applies. Like there's plenty of, or I have a couple clients that are physician assistants, and they have to be in their place of work, even though they make decent money. They have to be in their place of work for 10 years, you know, to have their loans forgiven. But we're also talking about well over $100,000 of forgiveness. Some people would say that's worth it. Some people would say, if I don't like my employer, I'm not going to stay here for 10 years. Keep moving. Taxes. Some people don't look at taxes as debt. You may or may not. That's another one. You can go to the next one. Taxes, child support, and alimony. And so those typically are the four. And you see student loan debt there, yes. But also, like I said, it's with a hybrid. If there are instances where you have a loan forgiveness program for your student loans, that is a possibility depending on your line of work. But child support and alimony, not going away. If somebody was to get divorced or separated respectively, I would not bank on your ex-spouse remarrying to get you out of having to pay child support and alimony. And I think they have to be married for, it depends on what state you're in, I believe, but they have to be married for X amount of years before that would even take effect. And so with anything, there are loopholes, but these are typically not very forgiving. And so those are things that you will not, or likely not get to have a loophole on. Can anyone give me the credit or a credit reporting agency that you know of?
Experian?
Experience? Like
Experian with an N at the end?
Oh, Experian. Yes. Experian is one of them. Yes.
Equifax? Is that the word? Equifax?
Equifax, yep. Yep. We're hitting it on the head. There we go.
TransUnion.
TransUnion. Yep. I call it the T. One starts with the T, the other starts with E's. And then you have annualcreditreport.com, credit reporting agencies. Next slide, please. Those are the big three. The first three that we heard, those are the big three. And typically it is it's tough. Some people don't know. They don't know. They see these names often, but they don't know because they're not paying attention to who they should be contacting. I mean, you don't have to contact them once a month or once a quarter, but I think you should check your credit report at minimum twice a year. So every other quarter, or in January and in June, or in June and in December, but typically December's semi-busy, in quotes, busy for everybody, saying that they're with family. You're not with family for 31 days, but okay. But you got to check. You got to stay up to date on your credit inquiries, because sometimes there is human or computer error, and you have a negative mark on your credit report that should not be there, and you can prove it. But if it's there and you don't check it often and see it and fix it fair, it's gonna sit there, and having that there 4 years from now, 6 years from now, does affect you, and it does affect your credit score as well, even if we're talking about 10 points. But I know I'd much rather be at an 805 credit score than a 795. How about you? So does anybody know the current rent? And the next slide is not going to help you, unfortunately. Don't go to it yet. But does anybody know what the credit score range is. Don't Google it. Don't Google it either. I know people, all this technology nowadays, you can't hold anybody accountable.
550 to 850?
550 net. Oh, you can definitely go lower than 550 negative.
Oh.
Unfortunately. It's right. It's yeah.
Is it 300 to 850?
Yes, 300 is bottom. 850 is not.
Not the top.
It has, so I mean, if you have an 850, you're excellent already. But yeah, it is. I was proven wrong by one of my former teammates a couple years ago. He was like, "Oh yeah, we applied for this car and something, and he had like an 870 something." I was like, "You can't even have an 870 something." And then he sent me a picture of the credit score on the hard inquiry from the dealership, and I was like, "Oh, like everybody thinks that 850 is the highest that you can go. No, you can get extra credit. You can have an 880, an 890, 900. Like, it is possible. It means that you're paying off your credit cards every month for, depending on where you're starting, a few years. Just call it 5 years, but it is possible, and nobody can deny you. Everybody wants you when you need financial. I want to call it assistance, but when you go to make inquiries for credit, for debt, for leveraging things in your future, if you have over an 800, you're already in heaven, so to speak, financially. But over at 850, you're perfect. It doesn't get purer than that. So, does anybody have questions on the credit reporting agencies? I mean, going to them.com is pretty much how you can get started setting up your account. And don't check the same one all the time. All three of Experian, Equifax, and TransUnion, they don't technically use the same exact criteria for your score. So TransUnion might give you a score of 785, Equifax, you might be 758, and Experian 765. It's in the same general area, but when people pull them, depending on what you're applying for your credit and why they're pulling your credit, some take the highest one, some take the lowest one. So you want to check them to make sure that they're all in sync. Because if your TransUnion score is 785 and your Experian score is 700, that's not even close. So you want to see why. And if Experian has a different report than TransUnion has, you might want to fix it. So, yeah. Can we go to the next slide, please? So, what makes up your score? The biggest, payment history, naturally, right? Mix of credit, whether you have some student loans, which is very minimal as far as impacting your score, but consumer debt versus what else do we have? Auto loans, the different mixture. If you have, like I was saying earlier, if you have 10 credit cards, you probably shouldn't, but it would be a negative thing for you to close out the account. So I would say if they're paid off, or if a majority of them are paid off, sweet, but take them out of your wallet, take them out of your pocket, out of your purse, out of your clutch, whatever it is that you hold them in, and you can carry one on you, maybe two, because I know people like to get their rewards and all that, but you do not need to have that many credit cards on you, let alone using them, unless you are paying them all off every single month. And most people don't have the capacity to keep up with that. That's a lot of apps and or logging in on a desktop and completing that transaction. Unless you still call in to pay your credit cards off, which there's nothing wrong with. My mom still does that. You shouldn't have that many. Balance to limit ratio. I know that I didn't answer the question directly with, getting the new vehicle, but the balance to limit ratio as far as credit goes is big. If you have over 30% of your available credit on a balance of any of the cards or all of them combined, it's probably going to have a negative impact on your score. Getting new credit, so those new inquiries that you have that are coming onto your credit report, that can impact it. And then the length. The longer that they see you being responsible, the more likely they're going to give you a good score. So any questions on the credit score ranges or what makes up the credit score from our audience today?
LeGuan, can you touch on something that you said just a minute ago, where if you have too many credit cards, not to close down the extra ones? So it's not just enough to have a few, like you just never want to close an account. Is that what you're saying?
Right. Because length of history, people are like, oh, that's only 15%. So if I close it out, it'll impact you a little bit. 15% is a lot. Would you like your employer to give you 15% less in your check? No. So why would you want 15% less on your credit score? Or why would you want your doings to impact 15% of that? And it's the same thing, but we're just talking about long money. When you go to get an auto loan, unless you're paying it off in a year, which most people aren't, that's impacting your long money, how much interest you're paying extra to get that car for the individual that was asking earlier. For a house, most people are looking at 30 years of interest payments, and your first 16 years of payments, you're paying very little on the principal of what you actually bought the house for. You're paying more of the interest. So when we start talking about closing out a credit card, to Harmony's question right there, if you close out a credit card, it negatively impacts you now because they might lower your score immediately, but also long-term because the length of history matters. The length of history matters. And so you want to have those accounts open as long as possible. If your longest one goes back to 2012, that's not even 10 years of history. So they don't know whether to trust you or not. If your first credit card goes back to 1995, okay, we're almost going on almost 30 years in the making, 30 years of history, and then that trickling onto the 15%, it matters. So I would not close those out. I would keep them open. For myself, I have I think four total, 2 through the bank and 2 that I actually use, 1 Costco and 1 for airlines. But I only have 2 on me, and I've gotten cards in the mail, and I'm like, I didn't order this. It was like, oh, I got my new card because the old ones that are in my safe expired. So I didn't even know they were expiring because I don't ever see them. So yeah. Yeah, Tom.
So, but just kind of to follow up on that, let's just say over time, maybe you opened a department store card in order to get a great deal. Maybe you did that a couple of times, and then maybe you have a benefits credit card that you use to make regular purchases. So over time, maybe you collect 4 or 5 or 6 of those, and you have them for an extended period of time. But like you said, there's a few of them that you only used them for a purpose, and then you got rid of them. Isn't it? I mean, what's the risk of having them open and identity theft or the data from a particular issuer getting stolen? I mean, I feel like to some extent, I do agree that having a few is helpful in terms of your credit score. But on the other hand, having several outstanding, even if you're not using them, puts you at risk for that kind of, either identity theft or potentially you potentially have them available, and then potentially you spiral. You get into a situation where you use it and then you use another one. You start making maybe poor decisions, and then pretty soon you're a bit overwhelmed because you've used a number of them. So I'm just curious what your thoughts are on that.
Yeah, and no, that's great. I appreciate that, because I never thought about it from that angle. Like if I was a bit of a loose cannon financially speaking, and didn't have the discipline. Well, one, I rarely go into my safe, so that's one thing. So I never see them. Like I said, with getting the new cards in the mail, I didn't even know the old ones were expiring. So I was like, why do I have these new credit cards? Because I never go into my safe unless I'm grabbing my passport to go international, travel wise. So I guess that's kind of my answer to the, keeping the 6 that you're not even using open, but also to address, your information being out there and whatnot. Your information is going to be out there. If somebody wants to hack you per se, I know all of us, I think, if you have a Facebook account, know somebody, or we've been hacked ourselves. If somebody wants to get your financial information, they're going to be able to. If somebody messes up like Equifax did a couple of years ago and has a breach of I don't know how many hundreds of thousands of people, that's on them. And I'm sure there's, for people that had information stolen and had negative impacts on their personal stuff, I'm sure Equifax is dealing with plenty of lawsuits in relation to that. But your information being out there with cards that are that have open accounts, but you're not carrying the card on you. So for the individuals that are at the gas station pumps and that have the card scan readers where they can walk by you and scan your card, the card's not on you, so it doesn't matter. And half the people that have the wallets in the purses or the phone cases that have the chip that blocks folks that are trying to scan your stuff on, a subway or on a bus or walking past them in the airport. I would say that's one of the things about being financially woke and knowing that's a thing. You might want to have something in your purse or in your wallet that blocks that, wherever your cards are at, that blocks anything from trying to pull that information off of there. So yeah, I guess that does that address the 2/3 questions of concern there?
Sure. I mean, I don't disagree with the perspectives that you have. I just personally, I have reviewed my credit report on a regular basis, and I do know that the ones that are open, I felt like just personally that say an old department store card that I haven't used in several years, or even more recently where I opened an account. I don't think I got a card for it. Maybe I did, but I wanted to make a particular purchase and wanted to use their 90 days of free credit. Right. It's just my personal perspective as a matter of practice is if I used it for something specific, once I get it paid off, I'll wait a couple of months and then I'll close that. I totally agree. Your information in all likelihood is out there. I just personally feel like having those kinds of accounts that aren't being used makes me nervous. I feel like there's a risk there.
Gotcha. Yeah. I mean, you're not wrong. There definitely is. There's a risk of having or keeping that one account open. But if your risk versus preference is worth the negative impact of closing the account out, like if you called a TransUnion and asked them, how is this going to negatively impact my score? And if it's worth the trade-off for your peace of mind, then do it. And there's nothing wrong with that. But that you're giving away that length of history, which is why I would say leave it open, especially if you know nothing's being charged to it, because they just see on if anybody's looked at the credit report, it just says okay every single month, like going back to inception. It's a very boring, it's very boring to look at, but it's nice having that long sheet, because when you see okays and everything is gray and nothing's red, that's in your favor.
Right. Yeah, no, that's a good point.
So
I'm older, so I have a lot of history.
Gotcha. So no, I appreciate that. I appreciate that, and allowing everybody to understand the not just scratching the surface on that topic. So thank you. So what if you have a good score of 7, Harmony? Oh, 780, and make some mistakes. You got, there we go. Here are some of the, I guess, I wouldn't say talking points, but thinking points, because they're pretty straightforward. Maxing out your card is not ideal for anybody, but you're also not going to get, it's a slap on the wrist. But to make up those 25, let's just say it does take off 45, 50 points. You can't just earn that back in like a month or two. It's going to take at least probably 6 months to regain that point deficit. Being late. If your credit card payments due April 18th, okay, you have till May 18th May 17th for that to be 30 days late. 100 points is a lot. Dropping from 800 to 700, 700 to 600, and so forth. It's a lot of points. A debt settlement, not as bad as I thought it would be. If you have to settle up with Visa, getting dinged 100 points, and you didn't have to come out of pocket, 15 grand, and only had to pay them 8,000 because you had half of it. I personally would take that deal to get dinged 125 points on my credit score. Foreclosure and bankruptcy. Like I said, bankruptcy is the last resort, but even if you were at 600 and went down to 380 versus being in just a horrible situation for I don't know how many years. Yeah, it's going to take some time to build that 380 back up to 650, but I'd much rather pay my bills, even though I would have a fairly high interest rate on anything that I apply for. Don't apply for stuff. Keep it simple. Build your credit through one card, because obviously you've declared bankruptcy, so there's been some financial struggles there for whatever the reasons are. But build your credit however you can. There's so many different ways that you can do it. And then once you get back up, then you can apply for that vehicle or that refinance or the home that you want. But until you're over that, I would say 575, 600 range, and those are just that range is the average, but it's not bad per se. You're probably gonna have to lean on somebody to be a co-signer if your credit score is under 500, because the numbers interest rate rise that you would be paying would be ridiculous without having that co-owner with whatever you're inquiring about. So next time. That's interesting. Did we miss a slide? Okay. No, we didn't. We'll go to the next slide. So how interest works, because a lot of people don't understand. So crash course. Cost of borrowing money I mentioned APR and APY earlier. APR is right there. APY is annual percentage yield. So similar. But often it's compounded this way. Monthly, 12%. Divide that by 12 months, okay, 1%. And then splitting that up into the daily amount ends up with you paying 0.03% over 365 days. Or not over 365 days, but each day. Now, when you're calculating your interest, balance times interest percentage for that period is what gives you that. So let's go back one slide. There we go. So, sorry. When you're buying a 3-year auto loan, okay, that's 36 months, right? $20,000. Now, if you were to walk up to somebody and say, okay, based off of your credit score, you're buying this $20,000 vehicle, but it's going to cost you a little over $26,000 to purchase. Who in here would take that deal and why? Please unmute if you have a response to that. 5, 4, 3. Ooh,
I was just gonna say, maybe if it's your only option, like if you need a ride, I guess. I would want to get something less expensive and not pay an extra $6,000, but I could see folks that are just like, I need a reliable car. I'm gonna do it.
Understood. You're in Portland, correct? Okay. So, so in my mind, I immediately think, okay, how much is the annual TriMet pass? Is that what it's called? The TriMet pass? I know anyway. So with that, and I'm looking at this $6,290, just call it $6,300. And I'm like, that's a lot of extra money over 3 years. And then I, split it up into 36 months extra, however you want to add it and dice it up. But then you look at the cost of the annual TriMet pass, and I understand TriMet does not cater to your schedule. So that's something that you would have to go back and forth in your own mind about. But it's like, okay, you pay $6,300 extra because you have a bad credit score. Whereas if you were closer to the 589 versus the 500, if you said, okay, I'm going to get a pass for a year and a half and build my credit score up, and say in a year and a half I can get my score up to like a 650, I don't think that the annual pass for TriMet is going to cost you $2,000, right? So those are the things to take into consideration. And I understand some people, the locations where they drop off and pick up, it's not close to where you live or where you need to go. So that might be completely out of the question. But like you said, if that's my only option, I got to take it. And that's what a lot of people do. But then again, they also do not live up to that standard of paying $730 a month versus the $642 that they could be paying in a year and a half or 2 years later. So, rhetorical question, who would rather pay $623 for being, one bracket down from the top, rather than $730 a month, saving $110, not to mention that interest rate, 7.6 versus 18.7. 7.6, that's to me is not good, even with a credit score of that, let alone 18.7. That's like a credit card percentage. And so you got to just understand and know, which goes back to the second or third slide, reading and understanding your contract. Are these numbers fixed and not moving over the next 3 years? Are they variable? And right now I'm seeing 7.6 if my FICO score is 700, but whether my FICO score goes up or down, that 7.6 could be 11.2 in 3 months. You never know until you read and understand your contract. And so I would stress that people need to do that. It's not something you need to sit there and study on for months on end, but you do before you sign the dotted line, need to understand what it is you're signing up for. Otherwise, you leave yourself in a vulnerable situation as to paying monies that you don't plan to and don't really care to pay. So we will go to 17. One more. Yep. So as far lending terms, fixed rate loan, variable rate loan, finance charge, unsecured loan, secured loan, collateral. Can anybody tell me what collateral is when we're talking about lending terms specifically? I see a hand raised, Tom. Oh.
It's usually the hard asset that secures the credit that you're taking. So, for example, in the auto loan, it's the car. It's in a home mortgage, it's the home. The end of the day, the people that are lending money are hoping that you're able to pay it off, and at the end of the term, you would then be the owner of the collateral. But on the other hand, if for whatever reason you're not able to pay off the loan in time, or you run into struggles or whatever, then the collateral is then what the lender has as that last resort. They can't get the repayment of the loan from the money you're paying each month, so potentially they'll repossess the collateral, the actual asset, the car, the home, or whatever.
Yes, exactly. Yeah, nailed it on the head. Couldn't have said it better. Couldn't have said it better. We have variable rate loan, the one which I highly dislike, but it is a thing. So the APR changes based on the benchmark of the or the index rate. So that rate many times increases, but it can also decrease. That's what I was saying earlier, where the 7.9 could be 11.2, or it could go up further than that, or it could go lower than that. A secured loan, a loan guaranteed by something of value, typically that's collateral. And then there's unsecured loans, where there's no collateral securing the loan. It's a lot harder to get an unsecured loan than it is to get a secured loan for the backing of whoever the lender is, naturally. Fixed rate, fairly self-explanatory. And then the finance charge. I think any human that was not, that didn't graduate high school with every concept of money awareness has had at least one finance charge in their lifetime, whether it was overdraft, whether it was a monthly fee on an account, checking or savings that you had opened, or a credit card fee, which some people you can't get those waived. All of them are finance charges, and so that is something that comes into play. So, next slide. Can we go next slide, please? Oh, yeah, here we go. So, as far as types of loans, revolving, you have credit cards, lines of credit. Has anybody here? Does anybody have a quick story of a line of credit, or not so much? I know we have a department store card potential example. Owen, Dusty.
Give an example. So line of credit, when you sign up for overdraft fee protection at the bank, what they do is they'll open up a line of credit for you, and it's often about $1,000. And anytime your account goes negative, they pull funds from that line of credit in to cover your basis, to cover whatever you went negative. Ultimately, over time, you have to pay that back, whether it's monthly or a one lump sum. And again, it goes back to being not informed in a younger life, where I had to learn that the line of credit wasn't another account of my money. It was borrowing money that I had to pay back.
Yeah, hit on the head. I mean, it's revolving. It's not going to go anywhere. The installments, if anybody's had a car payment or a home payment, and even if you're paying rent, that's an installment. It's not paying off anything. It's just continuing to pay towards your lease if you're renting. But and same thing for a car if you're leasing and not buying it to own. But installment payments, you don't buy a house or a car. Most people don't put $40,000 down on their car from the jump. Pay it off in installments. And the same thing for buying a house. You don't just pay cash for a $400,000 house. You pay a mortgage of $1,700, $1,800 a month, which probably for the same type of dwelling is what you'd be paying in rent, if not more. So, when you're paying 15 to $3,000 in rent, if anybody is renting here in the audience that's paying those numbers, you can definitely pay for a mortgage. I understand that other things come into play there, but you should definitely look into it, because paying somebody else's mortgage other than your own is not ideal for you long term. Then you have secured and unsecured, which I know we just went over, and I know we got to wrap up here in a second. Just so much in great conversation and questions that we've had today. Payday loans, not in your best interest. Short term, high interest. I was actually going to say that. I didn't even see it on the screen. It's a vicious cycle that you do not want to affiliate with. When people say like, "Oh, I get my check this Friday, but I don't have my check, but I need this $2,000 today for whatever reason." Well, in my mind, getting that $2,000 today from the payday loan, today's Tuesday or Monday, sorry, and waiting till Friday. Okay, so 4 days. Some people would say 5, and I'm pretty sure they count the day that you borrow as one day already. So Monday, Tuesday, Wednesday, Thursday, Friday. 5 days later, to get that $2,000, if it cost you $2,500, was that worth paying $500 to get your check 4 days earlier? Personally, no, for me. I understand folks that do that need the money for various reasons, but typically there's always a way around that, and you do not want to get into that habit. That's a waste of money. That $2,000 just dropped down to $1,500. Like that. So, so much information. I want to answer questions that you guys have, because real life scenarios versus going through the slides, which there's great curriculum on the slides, but I want to make sure I address any questions that folks have before we hop off. I know it's been a very quick hour that flew by. If nobody has questions, then I'll go through a couple more slides. But I just wanted, did we have anything coming in from Facebook Live?
No, we're good for now.
Okay, gotcha. we'll go 3, 4 slides, maybe 5. Oh, back one, sorry. Credit card cycle. I know I hit it on the head over and over, but maintaining it, finding the right card. Some people just apply for just any and every card. Finding the right card. Where do you spend your money at? Where should you be getting your rewards? If you're into that little cycle, there's nothing wrong with it, but maintaining it, using it, and paying it off. Figure out. Look at your, unless you spend cash, and if you do, you probably keep your receipts. Look at where your top 10 places of spending money are. And if some of those cross over for a card that you could have or do have, consider switching that card out and using that for that. I know a lot of people use their Citibank Costco card. They don't have a Citibank account besides their credit card, but that's who Costco's card is with. So they have a Citibank credit card. They get their gas at Costco. For the department stores, that's kind of up in the air. If you're all about tech and whatnot, and you're at Best Buy every single month, maybe that makes sense. If you're a fashionista and you're in and out of Nordstrom's, maybe that makes sense. If you travel a lot, you know, whoever American or Delta or Alaska is with, if you're in the Northwest, maybe that makes sense. But understanding it, using it, and paying it, and not spending more than what you have is big, to say the least. Does anybody here have federal versus private loans, or is everything fairly standard? Because I don't want to go over stuff that doesn't apply to our audience. No, be there. Okay. That is, I mean, that's everything I have for you guys. Everything else as far as in the slides and salary and whatnot would be something that we would need more time to dive into in conversation. And so just want to thank you for joining us today. There's just so many conversations that can be had around finance, credit, debt, all of the above, really. And so I just want to thank you guys for taking the time out to join us. And so, we had a question from Tom.
Actually, it's not a question. I think you did a great job. There's this topic. There's so many areas you could cover, and I just have to say the one slide that showed the $20,000 car loan at 3-year term. I mean, that's one of those picture worth 1,000 words things that
Right.
When people are considering debt, and whether that's a mortgage debt or a car debt or any kind of debt, you look at that and it's like, wow, if I have choices to make, it can really help help people make better choices. Not only, like you said, understanding what's written in the agreement, but you see the difference in the interest rates and the amount you pay. And that's like that mind blown moment where you start to wonder, oh, wow, is today really the day that I need to buy that thing if this is what it's going to cost me?
Right.
So
Yeah.
I thought you did a great job.
Much appreciated. Much appreciated. Thank you.
Thank you, Gwen. If folks have questions afterwards, or if you're watching this recording on Facebook or on YouTube, I did drop our email address in the comments. So definitely go ahead and let us know if you do have questions later on, and we can reach out to Financial Beginnings or we'll go on and get those answers for you. So all is not lost. If you think of something down the road, we can still definitely help out and track down answers. Again, I really want to thank you for being here with us and for a great presentation. We will be back for another round of workshops tomorrow. So go ahead and check out our website. There's also the link to that so you can get some more information on what's coming up. So thank you, everybody. Have a great week. Happy Monday, and we will see you all soon.
Sounds good. Thank you. Have a blessed
Thank
day.
you, everyone.